Ladies and gentlemen, it is 11 o'clock now, and let's start the investor briefing. My name is Ben In. I'm the Senior Rating Specialist and the Key Analyst for Ameetaz Capital and Qualitas Sukuk Berhad. Some quick household announcements before we start. You can submit questions in the Q&A box at the bottom of your screen throughout the session. If you encounter any technical issues, do use the Q&A box and we will try to resolve the issues. Please note that this webinar is being recorded and can be made available after the webinar ends if required. Attendees' microphones will be disabled upon entering and will be on listening and viewing mode only during the presentations. Today's presentation is best viewed on speaker view. Please ensure that it's fit to window mode. Before you leave, we will appreciate if you could complete the feedback form. The web browser window will be available once this Zoom meeting ends. We would also like to apologize in advance for any technical glitches. If you do get disconnected, please try and rejoin the session. Otherwise, you may dial in with the number provided in your confirmation email. So in today's presentation, what I will cover is Qualitas Medical's business overview and growth plans, the transaction structure and corporate reorganization, our rating approach, and our rating drivers. So a group overview. Qualitas Medical is owned by Southern Capital Group, Management and Others, and Sujit's Corporation. Founded in the 90s in Malaysia, the group has since expanded into Singapore in 2009 and Australia in 2010. Qualitas Medical has grown tremendously, mostly via acquisitions of brownfield clinics. It has also expanded into other services such as specialist care, medical imaging, dental, and allied health. The group's key operations are GP clinics and specialist care in Malaysia, GP and imaging centers in Australia, and GP clinics servicing the expatriate and high net worth segments in Singapore. We view Qualitas Medical to be geographically diversified, although there is some concentration in Australia. Australia makes up about 50% of top line and earnings. The remaining is split between Singapore and Malaysia almost equally. GP practice is the biggest top line and earnings contributor, which is a significant operating segment in all three countries. The next biggest contributor is imaging services, which is largely derived from its Australian operations. In Australia, imaging services actually contributes a higher revenue than its GP services. In recent years, specialist care has increased in prominence, mainly in Malaysia, where Qualitas has substantial medical centers specialized in eye care. This chart shows healthcare centers by countries and services. GP services is a mainstay in all three countries. However, there are market uniqueness in each country that has resulted in different growth strategies. In Malaysia, Qualitas has focused on growing the market presence of its GP clinics and in recent years expanded into other services such as specialist care and allied health. Including affiliate clinics, there are a total of 238 clinics, making it among the biggest, if not the largest chain in Malaysia. As the group does not own the affiliate clinics, it earns significantly less from these clinics and also lacks control in managing the operations of the clinics, which is why Qualitas's focus when it comes to M&As and growth is acquisition and ownership of clinics that it plans to acquire. This also differentiates Qualitas Medical from its close competitor, which mainly focuses on a franchise model. In Australia, where cost of medical services is highly regulated and covered mostly by Medicare, Qualitas is focused on providing higher value and differentiated services. Its healthcare centers in the country typically groups together different healthcare services. In Singapore, Qualitas Medical carved a niche in providing GP services to the expatriate and high net worth communities. In recent years, it has also expanded into the heartland regions. Qualitas Medical has had a steady growth trend in the last decade. Expansion has been mostly via acquisition of brownfield clinics. This acquisition of brownfield clinics allows Qualitas to expand faster in new areas with immediate access to existing base of doctors and customers. In the last 3 years, Qualitas also diversified into other offerings. It expanded into allied health in Malaysia and Australia, specialist care in Malaysia, including ambulatory care centers, and the Heartland Primary Care in Singapore. Qualitas Medical intends to step up its growth trajectory via M&As, particularly in Malaysia and Singapore, with an intention to achieve a more balanced contribution. It will increasingly explore acquisitions of clinic chains, particularly on the east coast of Peninsular Malaysia. The group plans to grow via acquisitions of up to 52 million annually, which is expected to generate OPBIT of about 8 million annually. The investments are envisaged to be funded by shareholders, Ameetaz Capital and Sujit's, although Sujit's investment will be confirmed later. Ameetaz Capital will fund its portion via issuance of subordinated perpetual sukuk. Any equity credit to be assigned to the perpetual sukuk will be subject to the finalized terms satisfying our credit criteria. Nonetheless, based on the current assumptions, debts and equity are projected to rise as the perpetual sukuk is assumed to achieve a 50% equity credit. The plan to acquire brownfield clinics at an average price of 6.5 times EBITDA is a significant factor, as the acquisitions will provide immediate and meaningful post-acquisition contribution to Qualitas. The plan for funding, which is to issue the subordinated perpetuals, and acquisition of businesses that provides a certain cash flow return, is a very key factor in managing its gearing and cash flow debt coverage moving forward, which, based on the current projections, both gearing and cash flow debt coverage is expected to improve on a gradual basis. Transaction structure and corporate reorganization. To recap, this is the current corporate structure. The focus is, of course, on Qualitas Medical Limited and its subsidiaries. This chart shows the structure before the completion of the acquisition, as well as the flow of consideration for the acquisition of Qualitas Medical. The consideration for the acquisition of 78.7% of Qualitas Medical is 340 million, which will be satisfied via 94 million cash and issuance of 246 million of RCPS. On the left is the existing structure with the addition of vendors SPV and QML shares SPV. Vendors SPV represents the interests of shareholders of SCG and management and others. QML shares SPV holds the 78.7% shares of Qualitas Medical. On the right of the chart, the first issuance of 205 million by the issuer will flow to the obligor, Ameetaz Capital. Based on a preliminary debt sizing of 205 million, 94 million will fund the partial payment of the 340 million consideration for the acquisition of Qualitas Medical. The balance of purchase consideration of 246 million will be satisfied via issuance of the RCPS by Ameetaz Sdn Berhad. In this final proposed structure, QML shares SPV is transferred under Ameetaz Capital. As the RCPS is issued by Ameetaz, there will be a liability of 246 million recognized by Ameetaz Capital to Ameetaz, shown here as 246 million of advances. Of the balance of 205 million initial issuance, 101 million will be advanced to Qualitas Medical to refinance most of its debts. The 101 million advance will be converted to equity via a rights issuance at a later date, which Sujis is likely to also subscribe pending their own investment approval. Post-rights issue, about 21.5 million of cash derived from Sujis' subscription of the rights issue will flow up to Ameetaz to partially redeem the RCPS. As such, the final amount of 224.5 million of RCPS and advances is expected to be subordinated to the proposed Sukuk program. We would like to highlight some key transaction features. The proposed Sukuk program is to facilitate partial cash payment of consideration to shareholders under the proposed reorganization. The proposed program is also to facilitate funding for future expansion and refinance most existing debts. The repayment of the senior Sukuk will be via dividends from Qualitas Medical channeled into the program's FSRA. The FSRA requires amounts to be built up at least 50% 6 months before and 100% 3 months before the due dates. The senior Sukuk will be secured by charge on Qualitas Medical's shares, amongst other charges. Based on the terms of the program, there will be restrictions on additional indebtedness at Qualitas Medical at no more than 20 million. Qualitas Medical is also looking at a potential IPO in the near future, which, if it happens, will be subject to a rating test. Rating approach. The proposed program allows for issue of senior and subordinated Sukuk. The ratings assigned for the senior and subordinate Sukuk are currently preliminary. The final ratings will only be assigned after RAM ratings have reviewed the finalized terms, including relevant terms that satisfy our equity credit criteria. The subordinated perpetual Sukuk is rated 2 notches below the senior Sukuk to reflect increased loss severity and risk of non-performance relative to the senior debts. Any equity credit accorded to the perpetual Sukuk and advances from Ameetaz will depend on the finalized terms meeting our equity credit criteria. Some key features expected of the perpetual Sukuk include it being deeply subordinated, deferability of profit payments, and a long maturity. We also expect the 224.5 million RCPS dividends to be non-cumulative and subordinated to the obligations of the Sukuk. We also expect the related advances recognized by Ameetaz Capital to have terms that mirror the RCPS. The focus of our rating is, of course, Ameetaz Capital being the obligor for the program. Post-reorganization exercise, Ameetaz Capital will own 78.7% of Qualitas Medical, and Qualitas Medical is envisaged to be the only operating group under Ameetaz Capital. As such, for our forward-looking assessment, we will be basing our assessment on consolidated pro forma accounts of Ameetaz Capital. However, when we assess historical performance, we will be looking only on Qualitas Medical, as Ameetaz Capital is not part of the group yet. Rating drivers. This is a snapshot of our positive and negative rating drivers. So we view Qualitas Medical to have a strong market position. In Malaysia, it has the widest GP chain with 238 clinics, which includes its affiliates and associates. In Australia, it is among the leaders in Sydney and Brisbane and Melbourne, providing a wider range of services for its healthcare centers. In Singapore, Qualitas Medical has carved itself a niche in serving the expatriate and high net worth communities. We also view Qualitas Medical to have a diversified earnings profile across the 3 countries that it operates in. Other than the geographical diversification, we also view that it has meaningful service diversification, where it also has significant contributions from medical imaging as well as specialist care in Malaysia. Qualitas Medical's plans on expansion, which is to focus on Malaysia and Singapore, is envisaged to improve its balance, its contribution from Malaysia and Singapore as well. We also view the primary healthcare sector to be defensive, mainly because it is a basic necessity. The primary healthcare sector is also has a healthy growth prospect in Malaysia, Singapore, and Australia, supported by the rising income levels in all 3 countries, as well as the growing awareness for healthcare. In these 3 countries, we also recognize that the population are aging, and that is also contributing to the growing awareness in healthcare. In the 3 countries, we note that government policies are supportive, mainly in improving primary care access for generally, again, to improve the preventive health services. The primary healthcare is viewed to be fragmented, especially in Malaysia. However, we do view that the competition is largely localized. Qualitas Medical has a proven acquisition and integration track record. It being having a more than a decade of M&A experience. We note that its M&As are guided by a clear investment strategy, overseen by senior management and also approved by its investment committee. It also has a track record a good track record in terms of improving the acquiree's patient volume, revenue, and cost structure post-acquisition. Qualitas Medical has had a steady growth in terms of its FFO generation in the last 5 years. This has also translated into strong FFO-DC in the past. Moving forward as the rise steadily. However, due to a step up in debts, the FFO debt coverage is expected to dip for the immediate year. Moving forward for the next 3 years, we do expect that the FFO-DC will improve gradually to about 0.25 times. On the flip side, we do view its balance sheet to be leveraged, mainly because of its debt-funded M&As in the past. Post-reorganization, as I mentioned, the debts is expected to step up, mainly because of a major portion of the debts is issued for the partial consideration paid for the reorganization. Nonetheless, even with a higher debt, we do expect that the gearing is expected to improve, however, remain elevated at around 0.8 to 1 times. The elevated gearing is viewed to be tolerable because of the defensive sector and Qualitas Medical's stable earnings. Other than its leveraged balance sheet, we do note that its balance sheet has a very significant goodwill, and this will expose the group to potential impairments. Nonetheless, what we note is that past impairments of goodwill has been benign, which is a reflection of its strong duty performed for its acquisitions. We also view Qualitas Medical to have an elevated execution and integration risk from its fast-paced expansion. As such, it is crucial for Qualitas Medical to adhere to its clear strategies of growth and prudent risk management. Other than the elevated risk, we also view that Qualitas Medical has some risk in exposure to forex movements, mainly from its RM-denominated Sukuk program versus operations in foreign currencies. Nonetheless, the terms of the Sukuk program requires that the senior Sukuk coupons to be hedged. With this, it has come to the last slide of my presentation. We will move into the Q&A session next, which will be moderated by Mr. Tong Man Wai, the Head of Corporate Ratings.